Hi, it's Nick Cato with Leo Barrick, and on today's episode of Tax Concepts for Deal Professionals, we're going to be talking about purchase price allocation. I get to ask this question all the time during deals. So, if you're doing a transaction that results in a tax basis step up to you as the buyer, and please see our other videos that talk about that. Oftentimes in the purchase agreement, you have to agree to how you're going to allocate the purchase price amongst the assets for tax purposes to kind of, obtain your tax basis step up. Now, there's a push and pull here, right? The buyers tend to want to have more value allocated to assets that depreciate quickly. That'd be things like inventory, AR, obviously, PP&E. So, it's a big one. So, any trucks or machinery or equipment, so on and so forth. That stuff tends to depreciate pretty quickly for tax purposes, and is also eligible for bonus depreciation, which means you can expense it, or a piece of it immediately. Whereas, if a lot of the purchase price is allocated to a premium, like an intangible asset like goodwill or going concern, contracts, so on and so forth, for tax purposes, that's generally amortized over a 15-year life straight line. So buyers tend to want to have more value allocable to assets that have a shorter tax life, so they get their deductions quicker, which often means a higher IRR. Now that isn't always the case, and you have to model it all out, but that is generally the case. Now, sellers, on the other hand, if they're U.S. individuals, or partnerships, S corps, DREs that flow up to a U.S. individual, they tend to not like having a lot of value allocated to things like AR, inventory, or PP&E, because the gain associated from that is often taxed at ordinary rates. And ordinary rates in the US for individuals can be quite high, often 15, 20% higher than, capital gain rates. And so as a seller, you have a motivation to have less value allocated to the PP&E and assets like that, and more value allocated to the intangible assets, which often, result in capital gain treatments to sellers. So there's a push and pull there. Sellers want more value allocated away from the assets that depreciate quicker, whereas buyers tend to want more value allocated there. And so when you're looking at purchase price allocation, at the end of the day, what people should be doing is, using fair market value. What is fair market value? But obviously, fair market value can mean a lot of different things to a lot of different people. And so there's a range in what is, quote unquote, the fair market value. And so it's important to understand the push and pull between a buyer and a seller around purchase price allocation as you're negotiating that in the stock purchase agreement. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.